guys? I'm JC Parets, and I'm the founder of allstarcharts.com. Welcome to the JC Show. So we started doing this about a couple of months back, and StockCharts TV was like, hey, JC, why don't you do a show? And they're like, what do you want the show to be about? And I was like, well, why don't we do this? Why don't we make sure that there's always a lesson, something educational for sure. I think that's important. Let's talk about the market, right? Let's look at some charts. What are we buying? What are we selling? Why are we doing that? And then let's answer some questions, right? I mean, that seems to be like a pretty basic show. We could stick to that plan. So far, we've done that. Thanks for all the feedback, guys. I really do appreciate that. People, sending messages and, sending questions. That always helps because makes my life easier if I got a whole bunch of questions to choose from. So we'll take it. All right. So I think today's lesson, I think we have to talk about this whole 7th place trophy society, that some people live in. And I didn't grow up that way. Though, I grew up playing sports my whole life. And I lost a lot, right? I was a baseball player. I struck out a lot. I got back-to-back home runs hit off me at UConn. And one of them was a great pitch. It was a curveball low and away. And he, it was one of those little doop, and he just like poked it over the fence. Another one, I left it up, and it's. I don't think it's landed yet. So that one I deserved. But one of the two of the back-to-back home runs that got hit off me at UConn was actually a great pitch, and there's just nothing you could do about it. So I could either cry to my mommy, or I could put on my big boy pants and get over it, right? And people are like, oh my God, the rule. I don't like the rules. These brokers are allowed to sell their order flow. They shouldn't be allowed to do that. Maybe, but they are allowed to do that, and they do that. So you could take your ball and go home if you want. You can complain about it all day if you want. You're allowed to do that in this country, right? We have that right to complain as much as we'd like, to bitch and moan about the rules. You can do that. You can complain that you don't like the regulators and how they whether they enforce these rules properly or not. You can complain about all that if you'd like. You have the right to do that. You can complain about those who are taking advantage of the rules if you'd like, right? They shouldn't be taking advantage of investors that way. You could feel that way, and maybe they shouldn't. Maybe you're right. Maybe they shouldn't. But they are, and they can, and they will continue to, right? And you might be realizing these things now, right? And you're complaining about it and all that stuff. But the rest of us figured this out a long time ago, right? Let's be serious. There are a lot of rules I don't like, right? A lot of them. There's a lot of regulatory and regulations and the people making the laws. There's a lot of things that I don't like about it. Sure, you can ask a lot of my friends and traders and PMs around the world, and they'll tell you the same thing. I guarantee you they have a list of things that they don't like, right? You might not, I certainly don't like some of the participants and how they take advantage of the market. Sure, for sure. Guess what? The system is rigged, right? It is rigged against you, right? We figured this out a long, long time ago. We did our complaining back then, and then we got over it. Right? And here we are. So you have two choices as an investor. You can complain and complain and complain. You can do that. Or you could take advantage of the situation and take advantage of those who are unaware of the way the market works, or in many cases, take advantage of those who don't care, right? And these are the types of people that are making donations to the market. They donate their hard-earned cash to the market. It's our job to extract that money from the market, right? Do you want to be the one making the donations, or do you want to be the one extracting the money? Obviously, I would rather be part of the latter group, right? We're the ones to take the money. So that's the deal. This is nothing new, right? Rules have sucked forever, right? I'm sure there are, you can come up with a list of rules you don't like, regulations you don't like, the ways that the brokers screw you over, selling this, doing that. I'm sure there's a whole lot of things you don't like. But guess what? There's nothing I can do about it. No one's going to listen to JC, right? JC can talk about all the things that are wrong with this market. I could do this all day. Guess what? Nobody's going to care, right? We have to look out for ourselves. No one's going to help us. We have to manage our own risk. The regular, they're not there to help you, right? Come on. You think the president is going to help you and your portfolio manage risk? No, nobody cares about you. The whole world is against you. It's just you. So the only thing that you can do, that I can do, that we can do as investors is protect ourselves, right? Manage our own risk, because everyone's trying to screw us. Everybody. That's the way the market works. So we can either cry about it or acknowledge that these are the cards that we've been dealt, and we could play the hand. We can pretend we have pocket aces all day long. You can do that, but that's just stupid. You got to play the cards that you are dealt. And these are the cards that were dealt. That's the deal. You might not like that the market's making all-time highs. That might not make sense to you, right? That, how is the market making all-time highs? The market keeps going up. You might not agree that that's what it should be doing, right? There are a lot of people that don't agree with that, but it is, right? It is doing that. All right, so that's my 2 cents. There are no 7th place trophies here, right? It's not an everybody wins, everybody gets a ribbon. Thank you for participating. No, that's not how this works. There are winners and there are losers. And fortunately, there are a lot of losers. A lot of people are losing. They're just making donations to the market. So that makes it easier for us who are trying to extract money from the market, because there's so many opportunities there, right? And people are so angry. And so, the media just does a beautiful job of distracting investors so they can pay attention to like the Reddit and, the gossip with the hedge funds and the Robinhood and all this stuff is fantastic, because everyone's paying attention to this nonsense and we're there taking money away from them. So I love it. I love everything about it. All right. It's something to show here that I think is really, really important. Let's see how we're doing here. Boom. All right. So the volatility index last week spikes to levels that it had never seen ever, with the S&P 500 within 5% of an all-time high. People are scared. People are angry. I don't know what everybody's so angry about. Stock market's making all-time highs. The world's never been a better place. More countries around the world are breaking out. Huge bases. More stocks are participating. I don't know what everyone's so angry about. Saturday Night Live on Saturday night, I don't know if you saw this. Saturday Night Live on Saturday night, obviously, JC. I sound like such a boomer. Saturday Night Live, the program on Saturday night. Anyway, on SNL, on 3 separate skits, they're telling you that the stock market is broken. If SNL is telling you that the stock market is broken, chances are the stock market is working just fine. The stock market is doing its job. It's taking money away from those that like making donations, and it's giving the money to those that are disciplined, those who are aware that, quote unquote, the market is rigged, those who are aware that there are rules that we don't like. Like, we know that. It's not anything new. Like, oh, yeah, everyone's trying to screw us. Yeah. You just figured that out now? Like, where have you been, right? So we figured that out a long time ago, and it's our job to take advantage of that. And people are scared. They're so scared. They're scared of their own shadow. They're in cash. Oh, my God, JC, the market's going to crash. These Redditors, oh, my God, all these hedge funds are going to collapse the market. Nope. All-time highs. And when you go back and you see these VIX spikes, those are sentiment resets. And typically, these sentiment resets happen after the market sells off, not as it's pushing up against new all-time highs. I can't think of anything more bullish. That's how I look at that. And then when you look at the sentiment readings, man, the AAII, there are more bears than bulls. How is that possible? Like, seriously, how is that possible? The stock market's making all-time highs, not just in the U.S., but around the world, emerging markets, China, Japan making 30-year highs, Europe, Germany's making all-time highs. And there are more bears than bulls? Like, how is that even possible? People are scared. Good. Let's take money away from them, right? People are ignorant to the way that the market works, right? And then I get pushback because I'm like, oh, my God, did you hear what Elizabeth Warren said? Did you hear what Elizabeth Warren said, this maniac? This maniac says that the price of stocks should be reflecting the company's fundamentals. She said that in public, out loud. And this is like a member of Congress is telling the world that the prices of stocks should be reflecting company fundamentals, like, that's a communist statement, right? Think about that. Price of stocks should be reflecting the company's fundamentals? Is she insane? Right? That's how I thought at first. Then after talking to some smart friends of mine, they're like, JC, settle down. Nobody's being a communist here, right? Relax. And I'm like, okay, I'm listening. They're like, well, not everyone has the experiences that we have working at trading firms, managing hedge funds, talking to all the smart people that we talk to. Most people don't have those experiences. So the only thing that they know is what they've read in books or what the people on the television, that people that still watch basic cable, like what they're told is that stocks, quote unquote, should reflect companies' fundamentals. If you've been around long enough, you know that's nonsense. That's just simply not true, right? This has been going on for hundreds and hundreds of years where you have moments in time, many, many, many moments in time where markets are not efficient. And in fact, they're incredibly inefficient. And you see these 12 sigma moves and, moves that in theory should only take place once every 10 billion years, but they happen on a weekly basis, right? So we know that markets are not efficient. They are almost efficient, to be clear. Markets are almost efficient. So by definition, they are not efficient. And that is what our job is, to find those inefficiencies. And I think this is one of them. Stock market's making all-time highs, and people are scared to death. SNL is telling you that the market is broken. Elizabeth Warren is making up these things, how stocks need to reflect company fundamentals. I think it's great. These are distractions that are keeping people away from piling into stocks, which is exactly what I think that we should continue to be doing. Again, it's not like I woke up this morning and got bullish equities. Like, this has been going on for a long time now, and it has worked out very much in our favor. Now, sticking with that theme in terms of sentiment, some of you don't like the AAII polls, right? I personally am not a huge fan. Some people hate them. I don't have any hate towards anything, but I'm not a huge fan. It's like 300 people. But we're seeing the same thing at the professional level, right? Here's the National Association of Active Investment Managers. And again, falling off a cliff from a sentiment standpoint. I think it's really, really fascinating. I think this is the beginning of a commodity super cycle, folks. I don't think that investors are prepared. I don't think at all. I think investors are underweight. Here's a chart I want to show. I think investors are underweight the red line, emerging markets, which are breaking out of a 12-year base to new all-time highs. I think people have almost no weight to the black line, which is the commodities index, and probably not enough weight to the blue line either, the S&P 500. So this is the performance of these markets since crude oil went negative on April the 20th of last year. Was that on 420? Can you guys check my math? Did crude oil trade negative on 420? That's interesting. Anyway, since then, emerging markets have been the leader. Commodities have been outperforming stocks by a lot, right? And it's not just energy, right? As we can see here, it's the ags, it's the base metals. Look at these base metals: copper, zinc, lead, aluminum, tin, nickel. They're ripping. You know what's not working? Gold, right? All the commodities except gold are working. To me, that's evidence of risk appetite, not evidence of risk aversion. People are like, well, JC, if this is the beginning of the commodity super cycle, that can be bearish for stocks, right? No, I don't think it is. Not, at least not yet. At some point, it probably will be, right? But I think that's a long ways away. I think this is a bigger story, right? Higher commodity costs, higher inflation, lower bond prices, higher interest rates, higher stock prices. Ultimately, are rates going to get too high and affect stocks? Probably. Are commodities going to get too high and that's going to affect stocks? Probably. That's the way the cycles work, right? But I think we're really far away from that. I mean, we have conversations internally about interest rates, and I'm going to pull that up right now. We have conversations internally about rates, and the question is, at what level does this start impacting equities? And a solid argument is 2%. I would argue over 3%. That's not anything I'm worried about. In fact, I would take the other side of that. I think higher interest rates is a positive catalyst for equities. Financials have been underperforming forever. Again, not just in the US, but globally. Why do you think Europe is such a serial underperformer? They don't have the technology that the United States has. They have a lot of banks, right? So if interest rates are going up, I think it's good for banks all over the world because interest rates aren't going up just in the US, but around the world also. It's a global phenomenon. So as interest rates are going up, it's good for banks. I think bank stocks do well. I think it's evidence of just risk appetite in general, inflationary forces, global growth, rates higher, stocks higher, commodities higher, bonds lower. That's how I see it. So 155, because I was like, all right, JC's such a Pollyanna, perma bull, bull-tard, right? I get called all this stuff, right? Call me whatever you want. I don't care. I'm a big boy, right? I've been called a lot worse. I spent plenty of time on trading floors, plenty of time in locker rooms. I've been called the worst things you could possibly imagine. It's all good, right? It's all good. Don't take it personally. Life's short. Enjoy life. Try smiling. Smiling helps. So 155 is my level there, guys, on the TLT. If we are below 155 on the TLT, I think the bet is higher rates, higher stocks, higher commodities, right? If we're above 155 on the TLT, rates start rolling over, chances are stocks are probably under pressure and you're going to feel it in commodities too. That's how I see that. So if you're looking for, okay, JC, what's it going to take for you to change your mind, you perma bull, right? I think it's TLT above 155. That's step one anyway. I think there's other things like rotation into consumer staples on a relative basis. I think that could be another. Aussie yen rolling over is probably another one. But you want to keep it simple, stupid. TLT 155. That's the level that I'm looking for there. If we're below 155, I think stocks are fine. From the short side, I'm looking at 153. That's probably the level. If you want to be short bonds, 153 is the level with a target of 138. If that's something that you're trying to do. Me personally, I'm not trying to short bonds here. I mean, I understand that trade. I'm all for it. It's fine. I'd rather just buy stocks. You know, I think there's more opportunity to the upside in stocks than there is to the downside in bonds. How's that sound? Right? Does that make sense? But we're looking at these. This is intermarket analysis, right? These are the intermarket relationships that we're analyzing. Let's talk about something else that could be a bummer towards this bull market is the US dollar index, right? When we're talking about the US dollar index, we've seen an inverse correlation with risk, right? So notice how when the dollar bottomed in early 2018, that's when stocks peaked. Again, not just in the US, but globally. Now, did stocks peak because the dollar bottomed, or did the dollar bottom because stocks peaked? I don't know. I don't care either. They're happening simultaneously. Dollar bottom, stocks peaked. And then what happened? The dollar peaked last March. What did stocks do since then? It went straight up, baby. Straight up. So the dollar peaked, stocks started rallying, and the dollar got slaughtered, right? And just think about how much gold sucks. If you would have told me that the dollar was going to do what it did over the last year, and you would have asked like 100 of my smartest friends what gold would have done, we would have all said up. And it's not. It's garbage, right? So it's interesting weakness in gold considering how the dollar did. Okay, fine. So now here we are at the same levels that the dollar bottomed 3 years ago. So if the dollar is going to bottom here, wouldn't this be a logical place for that to happen? You know? But let's flip that upside down and think about what the implications for equities could be if the dollar breaks down from here. We got to look at it both sides, right? So I think that's interesting. And dollar yen is right there. If dollar yen's going to rally, this would be a perfectly logical place for that to happen, right? Now let's look at 60% of the dollar index is euro. 120 is that level. So as long as we're above 120, I think the risk in euro is up. But if the euro rolls over and starts breaking back below that 120 level, and all that form of resistance turns support, break, resistance, and now we're trying to break out. If this rolls over and this is another failed breakout, that's got to be a bullish catalyst for the dollar. And I think that could be a bummer for equities in general, particularly the rotation into commodities, emerging markets, global growth. I think that's a bummer for all that stuff, right? So euro above 120, I think we're good. Let's take a look at some of the short squeeze candidates. Everybody's asking me, JC, what's going to be the next GameStop? What's going to be the next AMC? So this is a report that we've had internally for a long, long time. And, it's a great list, because a large short interest is a great catalyst for stocks to go up because those are natural buyers. You got these idiots that are like, short selling should be illegal. Speaking of communism, short selling should be illegal, JC. It's like, I don't know what you're so angry about, because anybody who's short has to buy that stock. The only way to unwind the short position is to buy it back. It's the only way. I mean, ideally for them, they want, for short, and I shouldn't say them, I short stocks too. For short sellers in general, in a perfect world, you want to be buying it back at a lower price and keeping the spread. But you're going to have to buy it back no matter what, no matter how high it is. You got these barstool guys getting slaughtered in these short squeezes, right? It's hilarious, right? By the way, if you follow like sports gambling websites into stocks and you lose money, you deserve it, right? You deserve it. So deal with it. Grow up. All right. So what are the potential next squeezes? So a couple of things that we're looking at here. Total short interest, right? So how much of the float is short? And then what's the short ratio? The short ratio is how many days to cover. So you'll take the short interest by the average volume, right? And kind of do the average daily volume and calculate how many days will it take for all the shorts to cover, right? And then listen, the data is kind of wishy-washy because it's like, well, volume can change, blah, blah, blah. So for us, it's less about the exact short ratio or the exact short interest, and it's more about just creating a universe of stocks that we should just go check out. Because the reason we're buying this is not because the short ratio is 6 instead of 4 or 8 instead of 7. That's not why we're buying it. We're buying the stock because it presents a favorable risk versus reward opportunity on the long side. And it's nice to have a nice little catalyst there that the shorts are getting squeezed. That's always good. Not just in the past couple of weeks. That's always been the case. They've been short selling forever, right? And the idea is if you're bullish, to take advantage of that, because they say that you shouldn't kick someone when they're down, but that's actually the best time to kick them, when they're down, right? So when the shorts are getting squeezed, you want to put your foot on their neck, right? And really take advantage of the fact that they're in a vulnerable position, right? So here's that list, and just a couple of names that I like here. Here's Live Person LPSN. I like this stock long. This is a 20% short interest here. Let's see, LPSN. So LPSN, we're looking at stocks at $67 as we speak, above our risk level. This is a software stock. It's a mid-cap, $4.5 billion stock, looking to break out on a relative basis here, right? And we want to be buyers if the stock's above 65. So if it's below 65, leave it alone. If it's above 65, I like it long with a target up near 96. What about ATUS, USA, ATUS? So ATUS is a $20 billion stock right near our risk level. This is a telecom communication services company. So 25% of the float is short. So you're looking at a short ratio of about 9. But for me, I like this major bottom taking place here. Love this. Resistance a few years back. We got the breakouts turning into support. This trade is only valid if it's above 35. For above 35, I like ATUS long with a target up near 48. And then finally, Dick's Sporting Goods. It's a store, specialty realty and specialty retail, and it's a mid-cap $6 billion stock. This is actually on our Young Aristocrats list, which are names that have consistently raised their dividends every year for between 5 and 9 consecutive years. And so this is, I love it when the same name comes out on multiple scans. So it's a Young Aristocrat that continues to raise its dividends. It's making new highs, and it's on our short squeeze list. I mean, man, just check, check, check. Relative strength is breaking out, positive momentum, and a favorable risk versus reward, most importantly. So we're looking, like I said, $6 billion mid-cap stock, specialty realtor, specialty retail. This has nothing to do with realtors. Specialty retail, a fifth of the float is short, 6-7 days to cover. But the bottom line is, the most important thing, the risk versus reward is skewed in our favor. It's already getting going. It's about halfway to our target. Maybe not halfway, but our target up near $90. We want to be buying any pullbacks towards 60. I like this a lot. Let me just show off the minor leaguers while we're having this conversation. These are the minor leaguers. This is us scouting the farm system, if you will, for to keep that baseball analogy. And these are stocks that are between $1 and $2 billion. And once you cross that $2 billion threshold, now you enter mid-cap status. So we're looking, and then ask any old timer, right? The old timers will tell you that the experienced traders will tell you their biggest winners of all time have come from mid-caps, right? Like that's just kind of like an industry standard. You can go back and do the work. I think there's actually quantitative analysis that suggests that, that looking for mid-cap stocks is really that sweet spot for growth, which is really interesting. So we try to stay one step ahead of the game here, obviously. So we're looking at them right before they graduate. So a small cap is between 300 million and 2 billion. That's a small cap. So for us, we're sort of elevating that criteria and putting our floor at $1 billion. So these stocks are between $1 and $2 billion. They're small caps. We're sorting by proximity to new highs because you're obviously not going to go from small cap to mid cap to large cap by making a lot of new lows, right? That's just math. So the only way you're going to graduate from small cap to mid cap is by making a lot of new highs, right? Go back at the greatest uptrends of all time. You know what you're going to find? You're going to find a lot of new highs. You know what you're not going to find in the greatest uptrends of all time? You're not going to find any new lows. You're not going to find any new lows, right? So I know that's common sense, but I think people forget that. All right, so minor leaguers, $1 to $2 billion. I'm going to show off an interesting name here that I like. AVYA Holdings, AVYA. AVYA Holdings. This is almost a $2 billion company. This is about to graduate into mid-cap status. It hasn't broken out yet, but I think it's about to. When it breaks above 24, we want to be long only if it's above 24 with a price target of 35, a software stock. So what do we know? Positive relative strength, positive momentum. It's the right sector. It's about to graduate into mid-cap status, and not to mention, talk about this beautiful base. So the way I learned it was the bigger the base, the higher in space. So we want to buy this while it's still a small cap as it graduates into mid-cap status. All right, great. So we got a couple of questions here that we'll answer before we get going today. And first question, JC, Jeff Bezos stepped down as CEO of Amazon. How's that going to affect the stock? I don't know what the CEO of a company has anything to do with the stock, right? It could be Jeff Bezos. It could be Santa Claus. I don't know. I have no idea what it has to do with the stock. I like Amazon long. I like the rotation back into these mega caps. Apple, Google. Check out Google today, for example. Apple, Google, Microsoft, NVIDIA, Adobe, Netflix. Keep an eye on these names. Tech, communications, consumer discretionary. These mega cap names look fantastic. So what does the CEO step down have anything to do with it? Good for him. Isn't he like the richest guy in the world? Let him go to a beach somewhere and chill out. Didn't he just get a divorce? Doesn't he have a new girlfriend or something? Have fun, Jeff. Enjoy, baby. And by the way, Jeff Bezos from Miami grew up in the same neighborhood as me, so repping that 305. And finally, JC, will the YOLOers ruin this bull market? No. I don't think the YOLOers are going to ruin any bull market. I think the only thing that the YOLOers are going to do is ruin themselves, right? Ruin their own portfolios, ruin their own lives, all that good stuff. But that's the way they're going to learn. I don't feel bad for them. In fact, I can even argue that I'm a bit envious of them that they are blowing up for the first time, which is when the learning process begins. We've all been there. We've all blown up. Let them blow up. Let them learn. It's the only way that they're ever going to learn. So, guys, fire away your questions. Shoot me an email. Say what's up. You can find me at allstarcharts.com. You can find me at allstarcharts on Twitter, StockTwits, Instagram, and YouTube. See you later, guys.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.